Hello, and welcome back to the Deep Dive, where we slice through the noise and get straight to the insights you need. Today, we're taking a deep dive into Shenandoah Telecommunications, or SHEN, S-E-N. That's a ticker NASDAQ, S-H-E-N. We've got a stack of fresh research here, an independent analysis dated September 1, 2025, that really lays out the landscape for this company, gives us a great roadmap. Now, right now, Shenandoah trades at around $13.25 a share. But here's the hook. Our sources suggest an intrinsic value that could be significantly higher. I think maybe $22 to $28 per share if they nail their strategy. So the big question we're going to unpack today is why such a massive gap? Are we looking at a hidden gem here, or is the market right to be skeptical about a company currently burning through hundreds of millions in cash? And here's where it gets really interesting because Shentel is a company betting big on a fiber-first future. It's a fascinating look at the J-curve effect in action.
Yeah, what's truly fascinating here is we're looking at a company in the middle of a profound transformation. I mean, really profound, moving to a pure play broadband provider. So, our mission today is to figure out if this really capital intensive fiber build out will ultimately lead to significant value or if it might just buckle under its own ambition. We'll be breaking down its business, the management financials, market position, who owns it, and yeah, the key risks too.
Okay, sounds good. And before we dive in, just a quick note. We're diving deep into the world of tickers here. Like and subscribe to Stock Analytics AI on YouTube. For just $4.99 a month, members get priority deep dives on specific tickers. And we're covering all of the S&P 500 stocks in the coming months, so members get priority access. Want a one-off deep dive on a company that's caught your eye? Just drop us a super thanks. All right, let's get started. To really appreciate this transformation story, we have to start at the ground level. Let's begin with Chapter 1, Business Analysis. So what exactly is Shenandoah Telecommunications, or Shentel, all about now?
Well, Shentel has fully transformed itself. It's now what we call a single segment, pure play broadband provider. Basically means they've streamlined things to focus almost exclusively on delivering internet services, mostly over fiber, but also some cable and fixed wireless, mainly in the mid-Atlantic region. And here's the key thing. Their revenue mix is strategically shifting. Growth is now overwhelmingly driven by their Glo Fiber Expansion Markets and commercial fiber services. Management projects, these new high-growth segments, will actually surpass their, legacy revenue by 2026. That's a critical inflection point.
Okay, so the focus is clearly high-speed internet, fiber specifically. What are their key products then, and how big is this network they're building?
Right. Their flagship is Glo Fiber. It offers really impressive symmetrical speeds, up to 5 gigabits per second. And symmetrical means you get the same super fast speed for uploads and downloads. That's a huge deal for how people use the internet today.
Yeah, definitely.
And alongside that, they offer modern streaming TV, voice services, and pretty robust commercial solutions for businesses, too. They are a significant regional operator. Over 17,700 route miles of fiber. That's a lot of fiber.
Huge number.
Yeah, passing roughly 623,000 homes and businesses. And Glo Fiber itself makes up 61% of those passings already. It's a massive regional footprint they've built up.
Okay, 17,700 miles. That's impressive. But what's their value proposition?
Yeah.
Why choose Shentel? You mentioned a smart niche.
Right. They specifically target what are called underserved Tier 3 and Tier 4 communities. Think smaller towns, more rural areas, places where the competition is often, slower, older tech like DSL, or maybe just one cable company with limited options. So by rolling out state-of-the-art fiber there, Shentel isn't just offering something better. Often they're offering the only truly modern high-speed option.
Where it's really needed.
Exactly, where it's truly needed. And that lets them grab market share pretty quickly.
That sounds like a smart strategy.
Right.
But what about the broader industry trends and, well, the competition? You mentioned giants like Verizon, Comcast, even Starlink is out there now.
Yeah, that's the challenge. Shentel is riding some powerful tailwinds, surging demand for high-speed data, obviously. The global fiber market is projected to grow like 10.7% annually, reaching over $43 billion by 2032. Plus, 5G rollouts need dense fiber backhaul, so the underlying trends are strong.
Okay.
But competition is intense. You've got the national giants, like you said, Verizon, Comcast, and then emerging players like Starlink targeting similar areas. So Shentel's success really hinges on dominating those less contested secondary markets effectively.
So digging into that, what really gives them a competitive advantage? What are the barriers to entry keeping others out?
Well, the biggest barrier, honestly, is the prohibitive capital cost. Building a fiber network from scratch is just incredibly expensive and takes a long time. Shentel also has a century-long history that gives them strong brand recognition, community ties. Don't underestimate that in smaller markets.
Right. Local presence matters.
It really does. But their dense owned 17,700 plus mile fiber network, that's their most critical, most defensible asset. It's extremely difficult for anyone else to replicate, especially economically. And recent moves, like selling their tower assets for almost $310 million
Right, I saw that.
and acquiring Horizon Telcom, show they're really disciplined, focusing capital on their core fiber business. It sharpens that growth story.
That gives us a great picture of the business. Okay, let's move on. Who's actually steering this ship through this huge transformation? Time for Chapter 2, Management Evaluation.
Yeah, this is interesting. September 1st, 2025 marks a key leadership transition. Christopher French, CEO since way back in 1988, is becoming executive chairman. And Edward, or Ed McKay, steps up as the new president and CEO. This wasn't sudden. It's a well-planned 5-year succession. McKay's a 29-year industry veteran. And crucially, he was the COO directly responsible for this whole fiber expansion strategy.
So the guy running the strategy is now in charge.
Exactly. His promotion is a really strong endorsement of the fiber-first strategy.
Okay, so they're putting the architect in charge. How transparent are they about all this, especially with the big spending involved? And how are they managing the money, the capital allocation?
They seem pretty transparent. Shentel maintains comprehensive investor relations, SEC filings, detailed earnings calls. You can find a lot of info. Connecting that to capital allocation, management is just laser focused on expanding core broadband, period. They're guiding for $260 to $290 million in capital expenditures for 2025. That's the CapEx, the investment in physical assets.
That's a big number for a company their size.
It is. And that sale of the cell towers for $309.9 million, that was a strategic move specifically to help fund this fiber build-out without issuing more stock. Then they made complementary acquisitions too.
That is a lot of investment. So what about shareholder returns, things like dividends or buybacks? Is that even part of the plan right now?
Well, there's no active share repurchase program at the moment, but Shentel does have a history of a consistent dividend. They've even increased it for 2 years straight. However, and this is important, their credit agreement restricts dividends based on their net leverage ratio, how much debt they have relative to earnings.
So the debt level dictates the dividend payout.
Pretty much. And that's key, given how much they're investing right now.
Makes sense. And how does all this investment show up in their return on invested capital, their ROIC? You mentioned the J-curve earlier.
Right, good connection. Their ROIC is currently negative. It's negative 0.94%.
Negative, okay.
And that raises the question, why? Well, it's a direct result of being in this massive multi-year investment cycle. Your invested capital goes way up as you build the network, but the profits from those new assets, they haven't fully kicked in yet. It takes time.
Right, you got to connect the customers.
Exactly. It's that classic J-curve effect. Think of the letter J, you go down first, spending heavily before you hopefully curve back up with much higher returns later. Shentel's right in that downward part of the curve now. Short-term profitability is sacrificed for that long-term growth potential. So the crucial point for you, the listener, is to look at that future potential, not just the current lagging indicator.
That J-curve is absolutely critical here. Okay, let's dig deeper into those numbers. On to Chapter 3, Financial Analysis. What does the financial profile actually look like for a company making such a massive bet?
Well, as you'd expect, the financials reflect a company deep in a capital-intensive transformation. It's a small cap stock right now, market cap around $727 million. But here's the positive sign. Revenue growth has been accelerating. It was up 21.9% in 2024 to $328.1 million.
Okay, that's strong growth.
Yeah, it signals that pivot to fiber is working. Management projects about 8.1% growth in 2025, helped by things like the Horizon Telecom acquisition.
Accelerating revenue sounds good, but if they're in that J-curve dip, profitability, cash flow, what's the story there?
Yeah, that's where you see the pressure. Profit margins are definitely compressed. Gross margin is healthy, 61.87%. So the direct cost of providing service is okay, but the operating margin is negative 6.14% and net profit margin is negative 9.32%. They had a net loss of $9 million in Q2 2025.
Oof.
And free cash flow, substantially negative, minus $251.25 million for the trailing 12 months. Management themselves expect CapEx to exceed cash flow through fiscal year 2026. So negative free cash flow for at least another year and a half.
Wow.
Again, it highlights that J-curve, deliberate short-term cash burn, betting on long-term growth.
So earnings are inconsistent, cash is flowing out. How do we gauge their financial stability with all this spending?
Well, earnings are inconsistent, and they get skewed by things like that one-time tower sale gain. On a continuing operations basis, net income is negative. Debt-wise, their debt-to-equity ratio is moderate, around 0.53 to 0.56. Total debt is about $513 million. Their current ratio, which measures short-term liquidity, is 0.73. That's below 1.0, which can signal short-term constraints. But it's not uncommon for companies in heavy build-out phases like this. The dividend is stable for now, but like we said, its long-term health depends entirely on generating positive cash flow eventually.
Right. So given these financials, negative earnings, negative cash flow, how do we even begin to value a company like this? Traditional metrics like PE are useless here, right?
Exactly. The standard price-to-earnings ratio is meaningless when earnings are negative. You can look at the price-to-sales ratio, the PS, it's 2.08. You can compare that to peers, see how much the market values each dollar of their sales.
Okay, something to compare at least.
Yeah. But really, for a company like Shentel in this phase, an intrinsic valuation method like a discounted cash flow or DCF analysis is much more appropriate. A DCF tries to project future free cash flows, assuming they do turn positive after 2026, as spending eases and subscribers grow, and then discounts them back to today's value. An educational DCF model we looked at suggests an intrinsic value range of $22 to $28 per share.
$22 to $28.
Yeah, but that's predicated on them achieving high single-digit revenue growth and assumes a weighted average cost of capital, or WACC, of 9–11%.
Okay, that's a powerful statement. A potential intrinsic value nearly double its current price, around $13.25. That really brings us to the market's view. Let's explore what the market thinks about this. On to Chapter 4, Market Sentiment.
Right, so analyst sentiment is predominantly bullish. The average 12-month price target is $26. That implies like a 96% potential upside from the current price. The consensus rating is buy.
Okay, analysts like it.
Generally, yes, but there's a notable divergence. A recent downgrade to strong sell from one source, Wall Street Zen. So the significant gap between the current market price and those high analyst targets, it just screams deep skepticism from the broader market about the execution risks.
The market saying, show me the money, literally.
Pretty much. They want to see proof that the strategy is working and cash flow will turn positive before they fully buy in.
So the market's cautious. What else are market indicators telling us? Short interest, technicals.
Short interest is at 5.07% of the float. That's moderate, not extreme, but it shows a decent number of bearish bets out there, likely focused on that cash burn and the execution risks we keep mentioning.
Okay.
Technically, the stock chart, it's kind of mixed. It's trading just below its 50-day moving average, which suggests some short-term negative momentum, but it's above its 200-day moving average, which is often seen as a more bullish long-term signal, maybe suggesting it's found a base.
Interesting mix. Skepticism, but maybe some underlying long-term support. So who actually owns Shentel? Who are the big players placing bets here? Let's turn to Chapter 5, Ownership Structure.
Yeah, this is really interesting. Institutional ownership is substantial. Depending on the source, it's somewhere between, say, 62% and almost 77%. You see the big passive funds like BlackRock and Vanguard in there.
As expected.
Right. But also active managers, notably Energy Capital Partners, or ECP. And what's truly compelling here, arguably the strongest signal of confidence you could ask for, is the consistent open market buying by entities linked to ECP. They've bought over 725,000 shares, worth more than $10 million, just in the last 90 days alone.
Wow. $10 million in 3 months from an active manager with deep industry expertise.
Exactly. This is sophisticated money, people who understand the telecom space deeply, putting significant capital on the line, saying they think it's undervalued.
That is a significant vote of confidence.
Yeah.
What about the concentration of this ownership? Does having big players involved change things?
Ownership is relatively concentrated. The top 5 institutions control over 38% of the shares. Now, that can be good. It can lead to more engaged corporate governance because these big owners have a real stake and a loud voice.
Right, to pay attention.
But it also introduces risk. If one of those major shareholders decides to sell a big chunk, it could definitely put downward pressure on the stock price, regardless of fundamentals.
Okay, so it's definitely a high-stakes game with big players involved. We've talked potential, we've talked market doubts. What are the key risks Shentel faces? What could actually derail this whole plan? Let's unpack Chapter 6, Risk Assessment.
Okay, if we do a quick SWOT analysis, strengths, weaknesses, opportunities, threats. Strengths are clearly that extensive fiber network, the strong brand in their markets. Weaknesses. You've hit these hard. Current unprofitability, the high cash burn, significant debt load. Execution risk is huge.
Yeah, that execution risk seems central.
It really is. Opportunities include that large underserved market, those secular tailwinds pushing fiber demand, threats, intense competition, that execution risk again, and potential financing challenges if things go wrong.
This raises an important question. How do macroeconomic factors play into this? Things like inflation, interest rates.
Oh, they're highly sensitive to the macro environment. Inflation, currently around 2.7% in this analysis, directly bumps up costs for labor, fuel, all the materials needed for the build out.
Makes everything more expensive.
Exactly. And rising interest rates, the Fed rate at 4.50%, 10-year Treasury around 4.22% in the source, directly increase borrowing costs. They have over $500 million in debt, remember.
Right.
However, there's a flip side. These same headwinds, high costs, and interest rates also make it harder for competitors to enter or build out. It raises the barriers to entry.
Ah, interesting. So it could lead to a more rational, competitive landscape long term. Less overbuilding.
Potentially, yes, it's a double-edged sword. It makes things harder for Shentel, but also potentially harder for rivals.
Okay, what about geopolitical risks? Anything specific on that front?
Yeah, there's one mentioned specifically, the potential for new U.S.-imposed tariffs on telecom equipment or raw materials. Management explicitly flags this. They state their 2025 financial guidance does not account for an evolving tariff environment.
So that's an unpriced risk.
Exactly. If significant tariffs came in, it would directly increase their capex, potentially forcing them to scale back plans or seek more expensive financing. It's a material risk to watch.
Okay, we have covered a ton of ground, from the fiber-first strategy, the whole J-curve financial picture, the market skepticism versus that insider buying. Let's bring it all together for Chapter 7. Conclusion.
Yeah, the investment case for Shentel is really a study in contrasts. You've got a clear bull narrative and a clear bear narrative. The bull case, it rests on a compelling long-term value story, a pure-play fiber provider building a really hard-to-replicate asset in growing underserved markets, led by an experienced team who knows the plan inside out. And that strong insider buying from energy capital partners, that's a powerful signal someone with deep pockets and knowledge believes it's undervalued.
Okay, that's the bull case.
The bear case, it's grounded in those very real near-term challenges. No profits right now, burning through hundreds of millions in cash, immense execution risk on actually building this network successfully and on budget, plus formidable competition in a tough macro environment. The market's deep skepticism, shown in that stock price, isn't totally unfounded. There are real hurdles.
So wrapping it up, what does this all mean for you, the listener, looking at that valuation gap we started with?
Well, the current share price, around $13.25, is trading at a steep discount, a big discount to both that consensus analyst target of $26 and our educational DCF range of $22 to $28 per share. That suggests significant potential upside if the company executes and the strategy unfolds as planned. It really represents a classic value investing scenario, potentially. The market seems fixated on the near-term problems, the cash burn, maybe obscuring the long-term value they're trying to build, literally fiber by fiber.
The journey of Shenandoah Telecommunications is definitely a powerful reminder that sometimes, yeah, the biggest opportunities can lie hidden within the biggest transformations, especially when a company is willing to go through that painful J-curve investment phase. The ultimate outcome for Shentel really boils down to management's ability to execute. Can they build out the fiber efficiently, turn those passings into paying, profitable subscribers, and finally navigate that path to sustained positive free cash flow? It's definitely something to mull over, a fascinating case study. And remember, for more exclusive deep dives into specific stock tickers, like and subscribe to Stock Analytics AI on YouTube. Members get priority access for just $4.99 a month, and we're covering all the S&P 500 stocks in the coming months. Or if you just want a one-off deep dive on a company you're interested in, send us a super thanks.
And as always, please remember this analysis was generated by an AI system. It's for educational purposes only and should definitely not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions. Thanks for joining us for this deep dive.